Okay, all right. It is 8:30 right on the button here. So I want to say good morning and welcome everybody. My name is Mickey Fitch-Collins. I'm super excited to see everybody joining us this morning. Welcome from Learn It, welcome from the offsite community. Would love for folks to, Dave already started us off in the chat there, but I'd love for folks to be able to share kind of where you're coming from, where you're tuning in. We have a global audience for our offsite presentation. So would love to hear where folks are coming from. Put that in the chat. Really excited about our topic this morning and very excited to have special guest Kevin Christensen joining us here today, talking about how to overcome economic uncertainty and focus on what really matters. I know that this is a topic I'm personally very interested in, and I think a lot of folks are going to get a lot out of it. To those of you who are new to these events and or maybe unfamiliar with Learn It, it's great to meet you, and let me give you a chance to get familiar with our organization. Learn It is a learning and development organization. We're based out of San Francisco, California, but we are located nationwide and have a global audience. We are committed to helping individuals learn the skills needed to thrive in the workplace, and we work with organizations and companies to improve company culture and build scalable training programs. I know I see some familiar faces and names, well, not faces yet, but names that are coming in the panelists and participant group. So those of you who are coming back for more, I love to see those. And those of you who are new, I'm happy to welcome you here. We host these events every other Friday at 8:30 Pacific Standard Time. And again, we're on a mission to make professional development resources and learning more accessible, which is why we host these 3 free events. These events are a way for us to connect in community across the Zoomiverse, right? And a way for you to get a flavor of some of our content as well as our special guests like Kevin that we're having today. A couple of housekeeping items before I pass the mic over to Kevin. This session is being recorded and will be available in our offsite community at a later time. We'll share a little bit more about what offsite is and all that sort of stuff at the back end of the presentation. But for right now, I would like to introduce and read a little bit of information about Kevin here so that you can familiarize with this wonderful gentleman before he gets into his presentation. Kevin is founder and financial planner at Aligned Financial Planning, focused on helping charitably inclined individuals, business owners, and donors of nonprofits align their money with their personal values, which I just love that. Kevin launched his career in financial planning in 2008 in the midst of the Great Recession. So good for you, Kevin. I love that you dug right in when times were rough. Although it was a difficult and uncertain time, he was able to learn through that unique period and now uses that experience with his clients. Kevin's involved with Big Brothers Big Sisters of San Diego County as a board member, mentor, and speaker. With a degree in business finance from Point Loma Nazarene University, Kevin continues to remain involved with his alma mater as a board member of the PLNU Business Alumni Association. He holds an advanced designation as a certified financial planner and an accredited investment fiduciary. When Kevin isn't working or isn't involved in those charities, you'll find him out exploring restaurants, playing golf, spending time in the outdoors in San Diego with his wife and their 2 kids. Today, he's sharing insights on how to overcome economic uncertainty and focus on what really matters. I invite you all to sit back, relax, enjoy. I am going to upload a handout. I did put this in the notice, the events notice on our webpage, but I'm going to go ahead and put that in the chat here as well, as Kevin's going to reference it. And I'm going to stop sharing my screen here and allow Kevin to go ahead and share his and get started. So if we can just in the chat share a little bit of love and welcome for Kevin, that would be great. And Kevin, take it away.
Thank you so much, Mickey. And thanks everyone for tuning in today. I'm excited to be sharing some thoughts. Mickey said to sit back and relax. There will be some of that, but there's also going to be some interactive pieces as well that will require some involvement. We will start with a fun disclosure in the finance industry. Of course, there's always disclosures. So general information only, not intended to be advice. This person is way too excited for a disclosure at 8:30 in the morning on a Friday. But I guess it's interesting material. So the agenda, we're going to start with talking about what's most important in life. We're going to get into just kind of what's happening in the world right now. There's a lot going on, some best practices and even some things to avoid during times like this. And then, the title is focusing on what really matters. So that's getting into some values and goals, and then we'll talk about some next steps as well. So we're going to jump right in. I know it's Friday morning, but we're going to start with some deep thoughts. And there's 3 questions I'm going to pose to you. Just think about it. I'll give you a few moments just to think about those responses for your life. But the first one, and I'll preface this by saying there's this whole movement of financial planning called life planning. There's the godfather of life planning is a guy by the name of George Kinder. So these questions actually came from him under that practice. But the first one is, if you woke up one morning and had all the money you needed for the rest of your life, what would you do with your life? So I'll give you about 10 or 15 seconds just to think about that question and how it applies to you. The next question is, what if you learned that you only had 5 to 10 more years to live? What then would you do? So now we're talking about a shorter timeline. What would change in your life? And as you can guess, the last question is even shorter. So what if you learned that you had a rare disease and only had 24 hours to live? What did you not get to do? Or what did you not get to be? So I know these are very deep questions, not only for a Friday morning, but just for starting out on this webinar. But I just want to get you in that mindset of focusing on what is most important in your life. It's easy to get caught up with work and all of life's demands. But if you think of it in this frame, it's really boiling it down to, what if you only had one more day left to live? How would you spend that day? And more importantly, what did you not get to accomplish? So be thinking in that mindset. Now we're going to do a big shift and talk about the current environment, and then we're going to come back to some more of the life planning conversation. So obviously there's a lot going on in the world. We have the Russia-Ukraine conflict, which is a tragedy in and of itself, but it's also having a ripple effect on the supply chain and oil and a lot of different areas. We have, we're either in a recession or potentially going into a recession, depending on how you look at it. So obviously a lot of uncertainty there. I'm sure you've seen inflation, prices at the pump and grocery stores and everything else. I mean, a lot of businesses are raising prices either because their prices have gone up or because they're able to and they can just blame it on inflation. But we're seeing, inflation we haven't seen in decades. We've had a stock market correction this year because of these other things. And, the Fed has been raising interest rates. The stock market has been coming back the last couple of months. So if you've seen any of your investment statements, those have probably come back in value, but we're still down overall for the year. And then we have midterm elections as well coming up this year, which just adds a little bit more to the pot. So that I don't want to spend too much time on the current situation. Obviously, there's a lot of variables and a lot of things going on in the world. But what I want to focus on, number one, is what are some best practices to help navigate what's going on? And then also, what can we control and what should we be focusing on? We can't control wars and conflicts and the stock market and recessions and things like that, but there's certain things we can do to help navigate. So I want to start with volatility, which is basically just, prices going up and down, especially as it relates to the stock market. It's actually a very normal thing. So in any period of time that you look at, there's always volatility in the stock market. We're just seeing, a more extreme version of it now. but it's very common. And I don't want to bore you with too many charts, but I will show you this one that I think sums it up really well. And this is annual returns of the stock market per year. So it starts in 1980 and goes all the way till this year. And all the lines, so this line across here is 0%. So all the bars above the line are positive years in the stock market, and you can see pretty good returns as well. The lines that go down from 0 are negative years in the stock market. So the first observation is, well, there's a lot more positive years than negative years. That's a good thing, at least historically. But the other thing is what's called an intra-year drawdown or decline. So these dots down here are the worst point of the stock market during the year, and the bars are where the stock market finished at the end of the year. So we'll look at, this is 2021, last year. The stock, is the size okay? Can you guys see it? I know it's a kind of a small chart. Okay. So last year, the stock market returned 27%, a really good year. However, it was down 5% earlier in the year before getting that 27% return. 2020, 16% return, very good return. However, look at this number down here, negative 34%. So if we rewind the clock, this is March of 2020, COVID was happening, a lot of uncertainty with the virus. The market had a huge pullback in the first part of the year, bottomed out in March, had a very strong recovery, and actually ended the year positive. 2019, 29% return. It was actually down 7% during the year. And I'm not going to go through every year, don't worry. The last one is 2018. It was actually a negative year for the stock market, down 6%. However, it was down 20% before that. This is all at the end of 2018. And so you can see if we go back every year, there's typically almost every year there is a negative drawdown, and the market for the most part comes back. It doesn't always end positive, obviously, but you can see historically the performance of the stock market. Now, that doesn't make it any easier to stomach as we're going through periods like this. And I'm not saying that it's going to be positive by the end of the year. Of course, that's a possibility, but not likely. But this just hopefully shows you the volatility of the market and how the market is pretty efficient overall, and does generate good returns. The second principle is controlling your emotions and behavior. Now, obviously, this is easier said than done. It's easy to get emotional with money, especially when you're losing money and your account values are going down in value. But we can't control the stock market. We can only control our response to the market. And so it's just managing those emotions. Number 3 is invest early and often. There's a Chinese proverb that says the best time to plant a tree was 20 years ago. Obviously, we can't go back in time and do that, but the second best time is today. So if you haven't started saving for the future, don't delay anymore. Start today or start now. Investing often is, there's a strategy called dollar cost averaging, where you're getting into the market and into investments on a regular basis. A good example of this is your 401k plan. So I'm sure a lot of you have access to a 401k plan. This is a way where every time you get paid, you have money going into investments, and as the market goes up and down in value, you're buying in at different points. And if you average that out, it typically ends up in a good position because you're buying high and you're buying low, and you can average it out. Right now, as the market's down, you're putting in the same dollar amount through your 401k, but you're actually buying more shares because the prices are down. So that can be beneficial over time. As the stock market eventually comes back, you'll be better off. So volatility actually can be a good thing financially, but it's tough emotionally. The next one is diversification. So diversification is, you've probably heard the saying, don't put all your eggs in one basket. It's buying different types of investments and different types of asset classes. And I'll show you in another chart the power of diversification. So this here is the asset class returns per year. And I'll define some of these because it's a little bit tough to see, but EM equity is emerging markets. So that's your smaller up and coming economies overseas. These are commodities. So this is precious metals and agriculture and some of those investments. DM equity is developed markets. So that's primarily Europe, but that's the larger economies overseas. Asset allocation is call it a 60-40 portfolio. So 60% stocks, 40% bonds. That would be an example of a diversified portfolio. Fixed income, those are your bonds. Large cap stocks, those are US based, but those are your Apple and Google and Amazon, the large companies. This is cash. High yield is essentially a riskier type of bond. Small cap stocks are still pretty large companies, but with the stock market, there's smaller companies, a lot of names you wouldn't even recognize. And REITs are real estate. So all these different types of investments, and you can see how they really move around quite a bit from year to year. And I'll use EM equity as an example. It's one of the riskiest asset classes, but it still serves a purpose in investing. And actually, if we look over here at the far right column, the VOL, that's the volatility. This is how risky an investment is and how much it moves up and down. So real estate is actually the highest, but a close second is this emerging markets equity. So if we look at 2007 and 2009, they led the pack. They did really well, and this is around the Great Recession. So, however, if you look at 2008, the year in between, they were all the way at the bottom. They lost 53% of their value during the Great Recession. So you can see how, oftentimes, here they are toward the top. 2017 at the top, 2020 did well. So emerging markets are often at the very top or the very bottom. You can see here, 2011, very bottom, 2018, 2021. So a very volatile asset class, but still provide, pretty good returns over time, just as an example. So that's why you don't want to put all your eggs in one basket and pick one type of investment. If we look at this asset allocation, this is the kind of the boring return. It's right there in the middle. There's always going to be asset classes that do better and that do worse. But if you have a diversified portfolio, you're not going up as high and you're not going down as low. You're right there in the middle of the pack, which is for a lot of people a good way to do it.
Kevin,
if you have
question,
yes.
Quick question that came in. Do you have a cheat sheet for the definitions of all the different type of asset classes, or something that you could point people to? You went through and kind of defined each one of those.
Yeah, I don't have a cheat sheet per se. I would say, take a picture of this slide, and there's a website called Investopedia that has a lot of good information. I don't know if they have one page that describes everything, but you can literally just type in, emerging markets, and it will have a description of what that is, what country sectors you'll typically find in emerging markets. That's probably the best resource, I would say, just off the cuff, but feel free to contact me, and I'm happy to look some things up and send it over as well.
Awesome. Thank you. I just put the link to Investopedia that Kevin mentioned in the chat there.
Perfect. Okay, so moving on, the next one is the importance of rebalancing. And this is another strategy that works really well when the market is doing very well, and also when the market is doing poorly. So rebalancing is essentially getting back to the target allocation. So I'll use that same 60-40 example with a diversified portfolio. So call it 60% stocks and 40% bonds. If the market is doing really well, like we've seen, leading up until this year, so 2019, 2020, and 2021, like we looked at, the market was really strong. In those periods of time, your 60-40 portfolio might shift to a 75-25 because stocks have done really well and bonds haven't performed, as well because they don't by nature. So now you have 75% in stocks when you should only have 60, assuming that you're in that 60-40 portfolio. You have to determine which one is appropriate for you. But rebalancing that account would basically be reducing your equities, your stocks, from 75% down to 60. So we're selling stocks and we're buying bonds to get you from a 25 back up to a 40% allocation. And so what you're doing is you're actually selling the investments that have done well, and you're adding that money to the investments that not that they've done poorly or underperformed, but relative to the portfolio have not done as well. So you're getting back in balance. If you did that in 2021, you would have protected a lot of those gains and not lost as much in 2022 because you would have been back in line with your target allocation. And conversely, it's also important to do when the market's down and what you're doing, that 60-40 maybe becomes a 55-45 because equities or stocks are down in value. So what you're doing is you're actually selling bonds and buying stocks. So you're buying stocks now at a discount because the stock market is down. So that's a little bit oversimplified, but that's just an example of if you have stocks and bonds in an account, the importance of rebalancing. And you can do that when there's certain things going on in the environment, or some platforms will just allow you to do it annually and it will automatically rebalance every year. The next one is finances should be aligned with your goals and values. This could be investing. Maybe you only want to invest in responsible companies. This could be in your savings. You determine what your goals are and you want to save in line with your goals. It could be the way you spend your money. And we have an exercise on that. Are you spending your money in line with your values, with what's most important to you? And it could be with your giving. You want to give to worthy causes and you want to align your giving with your values as well. The next one is take a longer view. And of course, I have a slide for that as well. If you had money to invest for the next 12 months and you invested all in stocks, this is based on historical averages, but you could get a 47% return or you could lose 39%. I don't love those odds. You invest $1,000, you could have $1,500 or you could be down to $600. Obviously not as extreme if you invest in bonds or if you invest in this is a 50-50 portfolio, but a diversified portfolio is not as extreme. But if we take it out to a 5-year period or a 10-year period, you can see how not only are these bars getting tighter, so that volatility is getting less, but they're also moving up. So if you invest in all stocks, and of course it depends on what stocks you're investing in, but all stocks over a 5-year period of time, you could be up 28% annualized per year or down 3%. I like those odds a lot better. And obviously, the longer we have to invest, the better the numbers look. Over a 20-year period of time, if we look at any 20-year rolling period in history, you essentially are not losing money, whether you invest in stocks, bonds, or diversified portfolio. So this is the benefit of looking at a longer time frame versus just looking at 1 year. Again, I don't like these odds of so much uncertainty for just looking at a 1-year period of time.
Kevin, we had a question come in from Jenny in the chat about
Sure.
What are some examples of accounts that rebalance themselves when you're talking about account rebalancing?
Yeah, so every platform is a little bit different. There's Schwab, there's Fidelity, there's Betterment, there's maybe you work with an advisor. There's a lot of different ways to invest. Something like a Betterment has become pretty popular over the years. and I know they do rebalancing automatically. I don't know if it's something you have to select or not, but I know that they rebalance, and they even do what's called tax loss harvesting, where if the market goes down in value, they're making trades that can be tax advantageous. But most online platforms have the option. Most 401k plans also have the option where you can rebalance on a set interval. So if you have a specific question on where your money is invested, I'm happy to take a look with you. But most, I don't know, the exact platforms, but most online platforms have a version of rebalancing that is either automatic or that you can select on your own. Great question, though. And the last one is a selfish plug for the industry. Realize the benefits of working with a professional. So this could be me or somebody like me. And I didn't include this slide, but there's actually something called the advisor alpha, which is essentially the extra return or the extra benefit you get on average from working with an advisor. And there's a study that was done by Vanguard, and I know some other companies have done it as well, where the advisor alpha is about 3% per year. So that's the difference of investing money on your own and getting emotional and potentially buying and selling at the wrong time, versus working with an advisor where you have to call them and say, I want to sell, and they will educate you and potentially talk you out of it. But that delta, according to the study, is about 3% per year. And the average fee for an advisor is about half of that or less, usually between 1 and 1.5%. So there's still, that added benefit potentially of working with an advisor just on the return side and part of the behavioral finance side. So we've talked about some things to do. Let's look at a few things not to do. Number one is panic. It's easy to do when you think the world might be coming to an end and you're losing money and you just want to cut your losses. But obviously panicking and selling everything is usually not the best thing, because by the time you get to that point, oftentimes it's toward the bottom of the market. And if you sell at that point, you have to, that's a tough decision in and of itself, but the tougher one is when do you get back in the market? Usually it's when you feel better, which means the stock market has already come back in value. Now you bought low and you sold low and you're going to buy back in high, which is the opposite of what you want to do. Watch the news. That's really the negative press. Obviously you want to keep up on current events, but it's really the negative news and also responding to that negative news. Checking your account balances daily. It just, I have clients that say, I don't even look at my account balances because I don't want to, worry about it too much, knowing that eventually the market will come back. And then also timing the market, very tough to do. And that's basically deciding when you want to be in or out of the market, when you want to buy and sell. Even the experts can't even get that right. So I don't recommend that. So now I want to focus on what really matters and the things that we can control. Obviously, I know I've thrown a lot of information at you, and a lot of that is kind of just the boring financial stuff. I want to get into more of the qualitative, softer side of financial planning, which I think is the area that really makes a difference. So my company, again, is Aligned Financial Planning. We help our clients align their money with their values. And this is the process that we go through to determine what their values are and how we should be investing and setting up their finances. So the first one is figuring out what is most important to you. The next is, what are you trying to achieve? Where is that stake in the ground in the future with retirement and education and everything else? And then we have to look at, where are we now? What's our current reality? And then that roadmap is what helps us close the gap between current reality and our future goals. So we're going to open up the chat here. And And just feel free to throw out some responses to the question, what's important to you? And this could be anything. There's another question outside of this, but do we get the slide decks? Yes, happy to send those out. I'll talk with Learn It, and I have some other resources I'll send out as well. The recording will be available, so you can review the slides that way as well. Having money when I retire, definitely something that's important. Anyone else? Funds for my kids for college, that's great. Family, that's a good one. Paying off student loans as fast as possible. All great responses. So there's a quote. I don't know who first coined it, but it's show me your calendar and bank account, and I'll show you what's most important in your life. I find this to be very true, where we may think that another thing is important to us, but if we look at how we spend our time and how we spend our money, that really shows us what is most important to us. Another response here, being able to live without constant worry. That's a great one. Stability. So we're going to go through this exercise. This is what was in the chat up above and also sent out in advance. But this is another exercise just to get you thinking. And if you have it in front of you, you can fill it out. It's not a fillable PDF, but if you have a physical copy, or just think about it, or just grab a piece of scratch paper or pull up your phone and start making some notes. Here it is again in the chat.
Could you zoom that in just a little bit? Sorry, Kevin, could you zoom it in a little bit?
Yeah.
Awesome, thank you.
Yeah. So essentially this is, I mentioned aligning your time and your money and your values. So the first step is figure out what your values are, what's important to you. These are some examples. You may have other things that are more important. These are probably the most common responses. But rank these. Ultimately 1 through 10. You may only want to do 1, 2, and 3 for now, just because of time. But just figure out, what are your most important priorities? Maybe it's your family, maybe it's your career, maybe it's your health, whatever it is, just start to rank those. And then in column 3 is the time. So how much time do you spend per week on all of these activities or these values? So how much quality time are you spending with your family or with your friends? How much time on your health? Maybe that's cooking healthy food or going to the gym, or maybe it's your emotional health or your spiritual health. Write down how much time you're spending on those things. You can skip the ranking until you've done everything 1 through 10, but you'll basically rank it from most time to least time, which of course, most people work a 40-hour work week. So, I mean, that oftentimes is toward the top of the ranking, which doesn't mean it's the most important thing in our life, but it's certainly important because it helps provide for all these other things. And then how much money do you spend per month on all of these values? And once you have that filled out, go ahead and rank those as well from the highest to lowest. And then ask yourself and reflect, are my top values getting most of my attention, most of my time and my money? And if not, ask yourself why. And I've seen this, it was actually eye-opening for me when I first went through the exercise of thinking that a certain value was my number one, but I wasn't devoting the time to it that I should be. So see if this resonates with you, and I would encourage you, spend some time on it later today or this weekend. Include your spouse or a friend or somebody else, just for accountability and to maybe help them out as well. Examples of financial security, that's a great question. So That would be essentially saving for your future. You know, some of the things that people mentioned, it's paying down debt, it's putting kids through college, it's saving money for retirement. It's all of those things. So some people really prioritize that, and they're devoting, there's only so much time you can devote to it, but they're reviewing their finances on a regular basis and they're setting goals. But the spending would apply more so. So I am saving $1,000 a month for my future because it's very important to me. Other people, they live in the now and they're not too concerned about the future, which will probably come back and haunt them down the road. But it's more important for them to live in the moment and enjoy life than necessarily save for the future. My personal take on that is having balance and living in moderation. You can't save every penny today and just hope that you'll enjoy your money in the future, because our future is not guaranteed. But you can't just live frivolously today and not worry about the future. So it's finding that balance. And is this based on daily, weekly, or monthly habits? So I guess the habits could be kind of broken down, I guess, personal preference and how your goals are. But in terms of this worksheet, the time is the hours per week. So I think it's 162 hours in a week. So how do you stack up in terms of allocating your time? And the spending would be per month. Oh, my mom is on the call. She saw this on Facebook. So of course she had to chime in and get some mom points there. Okay, so next goal. So after we identify the values, now it's talking about goals. So I like to frame it as SMART goals. It's specific, measurable, actionable, relevant, and time-bound. All those things make up, as I'm sure you guys have heard, this acronym called SMART goals. So it's deciding how you want your future to look, whether it's retirement. I know that came up in the chat. Saving for education for yourself or for your kids or others. Maybe it's traveling, buying a home, starting a business, paying down debt, giving to charity. There's a lot of demands for our time and money, and we have to allocate it and set goals for the future. So this is just an example, and I can send out a worksheet as well, but we'll start with retirement. So your goal is to have $1 million in your retirement accounts by age 65. That would be your goal. So we go through these filters. Is it specific? Yes. Is it measurable? You know exactly how much you need to have at 65, and you can even check in every 5-year time period to make sure you're on track for that goal. It's actionable. You say, I need to save, $600 a month to get to that goal. So it's very actionable. It's relevant because it's an important goal to you. And it's time bound. I have to have this done by 65. Now, obviously, that's a long ways away for a lot of people. So maybe you have a goal. Maybe you want to do a trip to Europe in 2025, and you know how much it will cost, and you can set your goal to save X amount per month to get to that goal. The next area is your current reality. So we have our goals. Maybe that's some of our dreams and aspirations. We don't know if it's actually realistic to get there. We have to look at where we are today to determine what roadmap needs to be in place to help us get to those goals. So let me I will show you an example. I know we don't have audio from the participants, but if I can have a volunteer type some numbers into the chat, and so we'll make this really interactive. You can either use your own figures if you're comfortable with it. This is going to be things like your income and your savings. So if you're not comfortable sharing your own numbers, which I can understand, you can just make up numbers, and I'll show you how this tool works. So do we have any volunteers that would be happy to do that? Rafaela Garcia raised a hand. And Gloria said yes. We'll just have whoever wants to chime in can chime in. So let me switch my screen here. And this is a program that I've developed that will actually produce a score between 1 and 100. You know, we have things like our FICO score, which show how good we are with debt. That doesn't really help us when we're planning for our future. It's important for borrowing money, but not necessarily on the saving and investing side. So let me pull up the chat here. So someone please chime in and just, you can give me a theoretical number of how much your income is this year. And don't say $10 million, but you just pick a number. All right, 85,000. And what was your income last year? Was it more or less? I see that we'll use the, 81. Okay, so it grew from 81 to 85. That's great. And how much of that money did you save? So 10% would be 8,000. 15% would be 12,000. All of it. Any other responses? A realistic amount. I save all my rate. Okay, so you're talking about the difference. So the 4,000 was saved. How much total of the 85,000 was saved? The raise plus, was there any other amount? I'll plug in a hypothetical number. We'll say $10,000. So the raise plus another 6,000 that was saved. And liquid assets, if 25%. Okay, so we can bump this up a little bit. Let's say 20,000. That's great. I have a feeling these are your numbers, Gloria. So good job for saving. Liquid assets. So how much money in the bank? And again, anyone can just chime in just so we can keep this going. 20,000 emergency fund, good. How much in retirement accounts? $20K savings, okay. So maybe this is 20 and 20, so we have 40. 140 in retirement. Any other non-retirement accounts? No, okay, so 0. And any debt, any auto loan balance? No, okay. Any credit card balance? Nope. Any student loans or mortgage? Looks like not. And then how much are your monthly expenses? We can back into this by saying, you know, income of 85, 20 goes to savings, another probably 20 to taxes, and so 4,000 is probably pretty close. Mortgage has 60,000, perfect. How much is your monthly mortgage? $1,250. Okay, so these are all the inputs. So it's a little bit hard on the fly, but basically your income last year and this year, how much you saved, your liquid assets, debt payments and debt balance, and monthly expenses. That's all we need to input. And then what this does, it's actually pretty close to the example we had, but it produces a score between 1 and 100. Savings rate, Gloria said it was 25%, so we're pretty close there. Income growth rate was 5%. The goal is to get up to 10. But you know, with you know, inflation, cost of living raises, usually that's only 2 or 3%. So this takes extra effort. Maybe it's a new job or a promotion. Maybe it's a side hustle. Retirement savings tracker. This is based on your age and income. Gloria, do you have a hypothetical age that you want to use? Right now we're looking at 47, but that could change this. Emergency fund is 8 months, so that's a little bit higher than what we're targeting here. but still good to have 8 months of cash reserves, and debt payments to income, 18%. That's pretty good. So if we want to look at what are some things we could change, savings rate that's a very healthy savings rate, but this is actually the most important factor here. So if I'm looking at things that could be enhanced, income growth rate obviously would help. So we have a 67 now. What if we were able to bump up our income even more? Now that goes up to a 69. And what if we, what if we save even more of our income? What if we save 25,000 instead of 20,000? Now this goes up to a 72. So I will say it's almost impossible to get to 100. You can see the savings rate goes from 0 to 50%. So 50% is very aggressive, but there are people saving 40, 50, 60% of their income. So we wanted those people to essentially get credit for those savings habits, but it's very tough to do. Even with a dual income household, it's very tough to save, 30, 40, 50% of your income. But I want to show you a quick example. If you do save more of your income, what that can actually look like. So the financial experts say to save 10 to 15% of your income per year for retirement. And that's great. But according to this chart, the left hand is your savings rate. The right hand is how much time you have to work before you can retire. 10 to 15% puts you at 40 to 50 years of working. So if you're 20 years old, you're going to work until 60 or 70. That's what most people do. But what if we can increase our savings rate to 25, 30, 40%? You can see how this number drops significantly. So in the example we looked at, where Gloria was saving 25% of her income, she can work for 32 years and essentially be retired, or have this work optional lifestyle. And if you can save 50% of your income, that's 17 years. So if you're 30 years old, you save half your income. In theory, obviously there's other factors, but in theory, you can stop working at age 47. So this really gets down to, what kind of life do you want to live? Do you want to work until you're 65, like the average American? I think it's actually maybe 62 or 63. But do you, alternatively, do you want to save a lot more throughout your career and have more options in the future? And maybe you want to continue working, maybe you don't. The reason that saving half of your income is so powerful, obviously you're saving 50% of your income every year, which adds up quickly. But the other thing that a lot of people don't realize is that if you make 100,000 and you save 50,000, not only are you saving a good amount per year, but you're getting used to only living on 50,000, not 100. So the amount that you have to replace when you stop working is not 100,000, it's only that 50,000 that you're accustomed to spending. So that's why the math works really well. And if you're saving 70% of your income, it's less than a decade before you can be financially independent. So just putting this out there as maybe something that could motivate you to save more now, because that's the main thing that's within our control.
Kevin, there's a question from Ann in the chat about a copy of that Excel worksheet, or is that something that's accessible with the financial planner, or how do folks get something like that?
Yeah, so I'm not able to send it out just because it's something that's proprietary, but I am happy to go through your score with you over the phone. So feel free to reach out to me, and I'm happy to go through that exercise. Right, like you saw, it's a pretty simple calculation. There's not a lot out there on the internet in terms of you can calculate a lot of those things manually, but in terms of having everything in one place, there's not much else out there that's like that. And eventually I think it will be something that becomes available publicly, but not currently. But everything else I'm happy to send out. And in the last few minutes here, wanted to wrap up with a few things. So The selected charity for today's session is Big Brothers Big Sisters of San Diego County. As you saw in the intro, I'm a board member and a previous Big Brother with the agency. But there are about 300 chapters across the country. So I know people are, and I think actually even some internationally, but I know people are all across the country. I don't know if there may have been an option to donate when you signed up, but I believe Learn It will be making a contribution to Big Brothers Big Sisters. If you have any desire to learn more about them, it's essentially one-to-one mentoring between an adult and a child. There's likely a chapter in your backyard. So if you have any interest in learning more, you could look up your local chapter. And I want to leave us with some action items. I will open it up for questions as well. So we have one here. Are the savings percentage pre-tax income or after tax? So typically we look at pre-tax. So you make $100,000 before taxes. How much of that are you saving? That's that suggested 10 to 15% range for retirement, but it depends on there's other variables. How much do you have currently in savings, and how old are you? If you're 50 years old and you haven't started saving for retirement, that 10 to 15% is not going to replace your current income. So that's for someone really just starting out in their 20s. Or if you've been saving that throughout your career, you can probably continue that amount and be okay, have a similar standard of living in retirement. So some action items. I know we have a group of HR professionals on the line. So what I know we didn't talk about this much, but an action item I would say is to evaluate your 401k plan. I know we talked about that being the main vehicle for employees to save for retirement. Even your overall company benefits. And this is something I can do, a free fee benchmarking analysis of your 401k plan to make sure that the costs are in line and the services are in line as well. Another action item for HR professionals would be to book a financial wellness session for your employees. This may be something you have through your 401k plan provider. A lot of them don't offer it. And, I can go through a workshop like this or a custom tailored version for your company. And then for the, just the general attendees, take time to complete the worksheets, your values, your goals. I have a cash flow worksheet I can send out, and also a net worth worksheet as well. So I will send those over to Mickey as a follow-up. Along with the slides as well. I'm happy to share those. And the final one is, if you have questions, contact me. If you want to get your financial score, I'm happy to do that, assuming I don't have 100 people that reach out for that. Or if you need help creating that roadmap of, here's where I am today. I know where I want to be in the future. I just don't know how to get there. Contact me. I'm happy to help with that. And that would be more of engaging me to, actually becoming a client. I can't do that for free, unfortunately. I know we've had questions throughout, but if you have questions now in the last few minutes, please feel free to drop them in the chat.
I think while we are waiting for questions to come in the chat, I will go ahead and just share a little plug here on our offsite community. Obviously, folks have gotten here because of participating with OffSite by Learn It, but we would love for you to scan that QR code or go to OffSite by Learn It, send the link to a few friends and colleagues. It's a free learning community that we've created. Gets you access to wonderful people like Kevin, all of our instructor community, to be able to engage in some of these awesome free sessions, and sometimes good previews of other information that we have as an organization. I also want to drop, so I'll drop a link for OffSite right there, so please share that out to your friends. And then in the chat here, this is the evaluation. That's a very long link, but this is the evaluation for the session today. We'd love for you to be able to provide some feedback to Kevin and to us at Learn It about the session. Very helpful sort of information that comes from when folks fill out those evaluations. So If you enjoyed this, folks are already doing it. Please share some love to Kevin in the chat. Kevin, thank you so much for taking time first thing in the morning on Friday to be here with us. Thank you, everybody, for being here. We obviously will hang out for a little bit of time here to see if any questions come in. But again, thank you, everybody, for joining us OffSite by Learn It. Thank you, Kevin, for joining us. And thank you from everybody across the world who's been with us this morning. So we'll just hang tight and wrap things up over the next couple of minutes here.
Great. I do have one final slide, Mickey. I'll go ahead and share my screen again. Just one last thought as we head into our Friday and our weekend here. Okay, so we talked about those 3 questions at the beginning. And the third one was, how would you spend your final 24 hours? So I want you to think about that answer again. And this should tell you what's most important. I mean, people think, this is, you hear stories of people on their deathbed and you say, what would you have changed in your life? What would you have done differently? A lot of it as I would have spent more time with my loved ones, with my family. I missed a lot of life's greatest moments. And so think about, how you would spend that last day. And I want to leave you with one final thought. And that is, what is stopping you from doing that today? Don't wait until your last 24 hours to really do what's most important for you. So with that, thank you so much for tuning in. If you have any questions, feel free to reach out. I'm happy to help.
All right, we'll just wait on the line here for a minute or so, see if any questions come in. Gary raised his hand there, but we can't enable audio. So Gary, if you have a question, can you just put it in the chat there?
So here's Gary. How does this affect you if you are unemployed? Do you have any particular section that you're asking about, Gary? I can speak generally, but if you're unemployed, obviously with that financial saving money, yeah. So without income, it's very tough to save money. So what I would say there is, your focus should be, assuming that you want to get back into the workforce, that should be your focus. Without income, it makes it tough to do a lot of things. So I would just spend all of your time networking, applying for jobs, even just thinking about what you want your next phase of life to be. And there's a saying that income or money solves problems. It sometimes creates new issues, but getting a job and being in a position to save money will make a big difference for you. So thinking of retirement, yeah. So my thoughts there would be, number one, if you're not working, if you have no income, it's very tough to save for retirement. But then also, like we looked at with your expenses, expenses drive a lot. So if your expenses are very low, then it's not going to take as much to get to retirement. But if your expenses are high, then that is tougher to replace. I mean, retirement is essentially you have enough income outside of work or assets that can provide income to you to cover all of your expenses for the rest of your life. So typically it takes a very large sum of money or something like a pension that provides income to do that, in addition to Social Security. Using your 401k. I mean, if there's, specific questions you have, it sounds like this might get a little bit more detailed, Gary, happy to chat with you. In terms of using your 401k, it depends on your age. And, there could be, there's always taxes if you take money out, but there could be penalties if you're, younger than age 59 and a half. So happy to chat specifically with you if you have questions about using your 401k. I don't know if that's something you're trying to use now or just thinking down the road in retirement. But if you need money and you have a 401k plan, that could potentially be a way to tap into it.
Okay, well, we are at time here. So again, I want to thank everybody for joining us this morning. And once again, Kevin, thank you so much for the very helpful information that you shared with everybody. Hope to see folks back later in September, mid-September. September 16th is our next one. We do not have one on September 2nd, but looking forward to seeing folks on September 16th. Please check that offsitebylernit.com. You'll see the next events in there. And I wish everybody a happy Friday and a healthy weekend, and we'll see everyone soon. Thanks so much.
Bye, everyone.